Hey there, everybody. Welcome to the 50th episode of Drunk Real Estate. It has been an awesome year, and we have spent the last year trying to bring you all of the topics we think you want to hear, from economics to real estate to politics and everything in between. But we want to make sure that for the next 50 and the 500 after that, that we're bringing you all the topics you really want to hear. So if there's anything that we should be talking about, any topics that you think we should be hitting over the next several episodes or the next several months, drop us a comment on YouTube or send me an email, j@jscott.com, just the letter J at jscott.com, and we will make sure that we hit the topics that you want to be hearing about. Thanks, everybody, for your support over the last 50 episodes, and we look forward to the next 50.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, welcome to episode L of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband. And boys, we made it to episode 50. We've been together over a year. I've had a great time. I'm having fun. Thanks for sticking it out with me.
I think I'm going to drink this episode to celebrate.
I would too. Actually, AJ's going to be drinking. He's got shots ready to go.
I did switch it up, so I'm going like heavy duty tonight.
Monster juice.
That's right. Fully leaded. I'm talking 250 milligrams of caffeine, all the sugar in the world, like pulling out all the stops for this one, guys.
And if you can't tell, AJ's a little bit down on his luck. He's now living in a van down by the river, eating government cheese. So
that's right.
He sold the jets and traded them in for the RV.
For the Winnebago, baby. So I'm actually in Ryan Murdoch's Winnebago. For those of you that don't know who Ryan Murdoch is, go look him up. He is like jacked, unbelievably jacked, but he's a real estate investor friend of ours. So we're here hanging out with a bunch of real estate investors, including Mauricio, your partner. She's here too, Bethany. So we've got a whole big crew, but that means we have a house full. So I'm out in his Winnebago now, so I can have some quiet, so I can join us here for the 50th.
Yeah, Murdoch's like the new Jay Martin, eh? Like Jay Martin used to be the guy, like the nomad, where he'd travel around and he'd invest in random, stuff all over the place. And now it's Murdoch is just all over the world, all over the country, just doing workouts on mountaintops and stuff like that. So yeah, go follow. We'll give him a free plug. Go follow Murdoch on Instagram or something.
He deserves it. He loves the show. He talks us up.
So Jay, are you drinking tonight?
I am. I just finished up my dark mocha latte decaf, mostly decaf, and I pulled out the Knob Creek. I pulled out the smoked maple bourbon, especially for this episode. Super excited. I'm going to drink a lot of this tonight because I am feeling really contrarian. Like I've been arguing all day for some reason, like all over social media, people have wanted to argue with me. In real life, people wanted to argue with me. So I'm just feeling really argumentative tonight. So let's have a good episode.
Really? So what's your opinion of the Trump verdict then?
You sure you want to go there?
Oh, I just wanted to try and get you into trouble, get something clippable.
Hey, look. I'm an equal opportunity go to prison person. He went in front of a jury of his peers. That jury was picked by both sides. He was found guilty. And if Hunter's the next to go, let them share a cell. If Biden's the next to go, let all three of them share a cell. I don't care.
And there with P. Diddy.
And P. Diddy, he can have his own cell. What he did is much worse than any of those guys.
All right, Mauricio, how's it going down there?
It's going good. I just want to say for the record, I lobbied hard to join AJ for the episode number 50, make it a big deal. And Kyle shot it down. He's like, no, we don't want to go. I've got some personal issues. I don't want to deal with it.
It's weird, man. Like they did this like private fitness challenge, and as like a reward for themselves, they rented a private Airbnb and they all got together and stayed together, and they're doing like this private chef and doing all this stuff. And you wanted to invite yourself to it. Like that's weird.
First of all, that's not accurate. But nevertheless, we could have gone, not for this special party tonight. We could have just gone. So anyway, it doesn't matter. So what I decided to do is that this is a special episode. I'm going to bust out a little champagne, a little Schramberg Blanc de Blanc. Let's pop it right here. Let's go. Oh, look at that. Here's our 50th anniversary glass. All right, take it away, Kyle.
I'm kind of feeling like I should have drank champagne as well.
Yeah, me too. We've got like 10 bottles of it sitting in our back fridge. I didn't
Should
even
I
think
call it
about
an
it.
audible? Get one of my kids to grab me a bottle of champagne?
Jay, just for the record, this is champagne. It's not sparkling wine from Costco.
No. Ours is from Trader Joe's.
Ooh, that's classy. You got it there.
We had a party a few months ago, and we bought like 50 bottles of champagne from Trader Joe's, and we still have like 10 bottles left.
Did you like it that much, or it was just that cheap?
It was my wife bought it, and she's not cheap. She's frugal.
All right. Well, if I don't sneak out and get a bottle of champagne while we're doing the intro, then I'm going to be. Well, our buddies at Clear came out with a new brand, so I felt like I had to plug it, and I think it's coming up with. We have the 4th of July coming up. They're feeling a little patriotic, so they have a completely new can here and 2 new flavors. One is actually all American lemonade, so they're jumping on the lemonade trade. No carbonation.
How much do these guys pay us for a sponsorship?
We pay them. We're investors. We give them money, and then we buy their stuff.
I buy so much of their shit.
Kyle, check this out. There's no carbonation on yours. I think it's all in this one. If you guys are watching, look at this carbonation, baby. You don't get that at Costco or Trader Joe's, Jay.
That must be a good glass, a perfect flute that's supposed to bring the bubbles out.
I don't mess around, dude. I don't mess around.
All right. I thought one of you guys would make a comment of the fact that I called it episode L, but I guess you just all know your Roman numerals and you just thought it was.
We trusted you knew yours.
No, I was actually going to make a comment because AJ then showed the drink and it's got an M. And I'm like, no, it's an L, not an M. So AJ's the one that's a little confused.
I am.
No, I still remember when back with the Super Bowl was Super Bowl 50, and so the thing was the Roman numerals an L, but they didn't want to put L in part of their logo, so they like broke from tradition, and this was the first time they didn't have the Roman numerals on the logo. It was a big deal. Everybody was like, that's tradition. Don't take my tradition, America. Let's get into this. All right, so we decided we're not talking about Trump. We're going to move on.
We just did.
We're not going to talk about the fact that he was convicted on 34 counts of fraud, and we're not going to talk about the appeals process. We're not going to talk about any of that stuff.
So how many more times do I have to say his name so we get the keywords in there and we get boosted in the ranks? All right, let's talk about the fact that the majority of Americans apparently think we're in a recession. So we've talked previously about the disconnect between the data and what's that showing and how people are feeling. Well, The Guardian, which is a website, commissioned a Harris poll where they asked 2,119 U.S. adults questions about investing and the economy. And the results were, well, let's say interesting. It came out that 55% of the respondents believe the economy is currently shrinking, with 56 believing that we are currently in a recession, despite all of our GDP prints. 49% believe the stock market was down for the year, despite the fact that it was up 24% in 2023 and up 12% year to date. And 50% of the respondents believe that unemployment is near a 50-year high, despite it actually being at a 50-year low. So, AJ, my question is, are these people dumb, grossly misinformed, or is it just reflecting what's really happening on the ground these days?
Can it be D, all of the above?
Yeah. I think it's a lot, not nearly as complex as it sounds and as economists try to make it. First of all, at the end of the day, how people are feeling, right, is how they're expressing about the economy. People aren't looking at figures to decide whether they feel comfortable about their economic position or not. They do that when they go to the grocery store. So I think that their reflection is based upon an inward feeling of what they're experiencing. And at the end of the day, when you're talking about a lot of things, that's one of the main driving forces. So I think that there's a disconnect because people don't feel like they are doing better. And this is a thing called driven around inflation. And so, there's this other article where it talks about how, Americans actually would prefer a recession over inflation. And so I think the disconnect is the actual experience of the individuals. and how they view where their money goes, their savings, how they're feeling things, rather than the overarching individual economic data that they're not looking at. They don't care, right? I mean, they're not sitting there analyzing these things. They're not reading the Wall Street Journal. That's not what they're doing. They're just trying to live their life. They're trying to buy cars. They're trying to buy houses. They're trying to get groceries. They're feeling about how well they feel positioned. The general population are not asset owners. So the fact that assets rise in prices don't affect them directly, whereas the rise in prices of general goods and services and how they are feeling about it does. And I think that's where
can I interrupt real quick?
Yeah.
Because you brought up this, and I saw this article, and I'm guessing you read the same thing or saw the same thing. For those that are not watching, just listening, basically the headline of the article is Fed President Neil Kashkari says that Americans have such a quote unquote visceral hatred of inflation that they'd rather have a recession than rising prices. And this pisses me off. So yeah, it's true. Americans would rather have a recession than high inflation. But so does the Fed. I mean, the fact that 2 years ago we had high inflation and the Fed said we're going to raise interest rates, we're going to raise interest rates high enough that it's likely to put us into a recession, tells me that the Fed feels the same way. The fact that the last 35 times we've had high inflation, the Fed has raised interest rates to put us into recession, says that the Fed feels the exact same way. So
it also shows that people are out of touch, right? Like everyone has this feeling that like, oh, a recession is bad, but it's not going to affect me that badly. Like people lose jobs in recession. So if you were to change the question around and be like, hey, would you rather have inflation or lose your job? What do you think they're going to answer?
Agreed. But I think it's worse than that. It's gaslighting. It's the Fed saying the people feel this way and they shouldn't, when in reality, this is the exact way that the Fed feels. And so I just, this gaslighting just pisses me off from the Fed, because this isn't unrealistic for people to feel this way. It's unrealistic for the Fed to pretend like they don't.
Look at Hip Jay throwing out the gaslighting, the word of the day there. Perfect.
No, it is.
Well, but you're right, because rising prices affect 100%. So this argument, though, where a recession people lose jobs, yeah, 5%, 4%. But rising prices affects everyone. No one can escape it. And you're talking inflation hits the hardest the people that can't bear it. That is the hardest group that is hit by inflation. And so, and two, I think I really do not want to, and I feel like you read some of these articles and they're talking down to people. Like this idea that we're not in a recession, see? Like, you don't get it. And you got like a single mother with 3 kids who's like, we're not in a recession. I can't pay for things. I'm not sure how I'm going to feed my kids. That is a recession to them. They don't have money. That's a personal recession, right? And so they're expressing a real position that they are in economically. And I think to say the stock market's up 24%, they're like, what do I care about that? Right. 90% of Americans are just trying to do
but 60% of households own stocks or some sort of, or participate in the stock market somehow. And yet still 50% of respondents still believe that the stock market was down for the year. Like that's just like,
yeah, but to AJ's point, that's like 401k. That's like 401k stuff. Like that. You if you ask those people, what stocks do you own? Well, first of all, you could ask them, do you own stocks? They may even say they don't know, because they actually own mutual funds. They own mutual funds, and then they don't even know what stocks or mutual funds they own. So they're not paying attention to that. That's something they're going to get when they're 65 or 70.
Then where are they getting their news from? I guess is my thing. It's the fact that like how do they believe that it's down? Like you're saying, how are they feeling it? Well, the stock market, they're not feeling anything. By your admission right there, they don't even look at it. So how are they coming up with this? Oh, the stock market's way down. Like it's,
well, if
like
somebody says, do you think the stock market's up or down? They're going, it's got to be down because things are so bad. My position is so bad. That's how they're coming. They're not going to somebody and saying, so did you know the stock market's down? No, they were taking a survey where they asked the people, do you think the stock market is up or down? They said, I don't know. It's got to be down because I am in such a bad position. I know everybody else is. All the all the moms in my mom group, right? All the dads are sitting here going, I'm working an extra job now. Things have got to be bad, right? And so they're simply responding.
And AJ, some of those stocks, too, people don't look at the stock market as a whole. I think people also look at individual stocks. And so suddenly there's a headline that says Tesla. Like I was just looking at Tesla because Tesla's down 25% in the last 6 months. Tesla is more likely to get headlines and other companies. And so they see that and they just say, oh, in the stock market, Tesla must be doing bad, or Disney comes out.
Well, that's the argument I always make. It's the media's fault, right? The media, like, it shows, like, if gas is below $3.50 or $3.50, you will not see a single headline about gas. It's not until things get bad with gas that all of a sudden there's negative headlines about gas. Like, the media is only going to perpetuate the negative narrative because that's the thing that gets clicks. And so when people are asked, hey, how are things doing? They've only seen negative media. And so in my opinion, it's like, this is just bad press that begets that people who keep clicking.
And I agree with this. And you got to look at it too, though, because we have a bias towards negativity always, because we are problem solvers. We're trying to solve problems. If you ask the average American, are Americans better off today than their parents' generation or your grandparents? Americans legitimately think that they live a worse life than their grandparents did. That's crazy. That is so wild for anyone to even say that when you're talking about millennials, who are the correspondents, that they are the largest homeowners of any generation that's ever lived. They have the largest disposable income of any generation. They have the largest time off than any generation. Their grandparents, right? Even look at the home ownership. The average home ownership today is 25,000 or 2,500 square feet. Our grandparents was 700 square feet.
You could still pick and choose a little bit, though. Like, if you want to talk about cost of living, like percentage of housing, their housing burden versus the cost of their, what their earnings are. If you want, like, you could pick and choose, and the previous generations had a much easier path to retirement and wealth than we currently do now.
But if that's true, then how come less of them? So we say that, but you're talking about a small group of people. So the more Americans today vastly own more assets. Millennials own way more assets than our grandparents did. They own more of the stock market. They own more real estate. They own all of them. So if you compare it, to say that they have an easier time, the numbers don't show that.
Well, pick your demographic too, right? So, like, if you're talking upper middle class, sure, yeah, like we have an easier time. But if you're talking about like lower income, lower class, like I would say their path to home ownership is next to nothing right now. Like, you cannot get out of that death spiral and get and own a home versus, somebody back in the day who was working a blue collar, just factory job, or, something that required very little specialized skills. You could own a home in 2 years. So, like, I guess pick your demographic, what you're talking about.
Then why didn't they? So then first of all, why didn't they? And then, by the way, who are we talking about? We're obviously not talking about minorities. So that's not true, right? So it's like today, home ownership is way bigger for the same generation comparative. So if they could, my question is, why didn't they? And so I think this bias towards negativity, though, we're skewed. Like, Americans think that right now, today in America, like, it's really, really, really bad. Like, they think that we are right in a horrific place, especially compared to other generations. But by almost the majority, all metrics, that is actually not true from 3 generations ago. And so I think it's the same.
No, I'll just say just a real quick, just a slight pushback on that. But, I've talked about this a lot. But I mean, again, if you ask your grandparents, that was usually one person in the household, the father or one of the parents was working, and they could afford a house and rent and 2 cars and whatever, and have two and a half kids or whatever the numbers are. And today, that's virtually impossible. You have to have both parents working, and maybe working double.
One person with a high school education.
Yeah. Let me tell you the numbers. 700 square foot home, not 2 cars. They didn't have 2 cars. The average female worked almost 80 hours a week in the home. A couple now inside the home work less than 15 hours to maintain the home together. And so the problem with that is, you're right. If you actually compare it, it was possible. But then you get a 700 square foot home with no garages. You get one car, right? And then you have somebody else that is actually working more inside the home than they are today at a regular job.
I mean, I feel like there's a lot of people, if they could buy a 700 square foot home right now, they would. They just aren't available. Like, that doesn't exist anymore. So, like, that's not necessarily their fault. But Jay, what were you going to say?
I want to add, so I 100% agree with AJ about the negativity bias, but I think there's another big bias that is playing a part here. And I would even argue it's probably the biggest one that's contributing to this, other than bad media, obviously, and ill-informed people. But recency bias. Recency bias is basically this idea that it's not necessarily where things are today that is going to inform how people feel about things, but it's where things are today compared to where they were yesterday. And if things are better than they were yesterday, people are going to tend to feel like things are better than they are. If things are worse than they were yesterday, people are going to tend to feel like things are worse than they are, because they're internalizing this trend more so than they're internalizing absolute numbers. They're not comparing, well, let's look at the historic data on delinquencies and credit card debt and all that. All they're looking at is, how much debt did I have last month or last year compared to what I have today? I have more, things are worse. And if I have a lot more, well, things are really bad. And so I think it's this recency bias that's driving a lot of this negative sentiment. But if you look at the data, and I think we should do a topic on this. I sent you guys something just before the show saying that this would be a good topic, upcoming topic, but talking about household finances. But the reality is, if you look at things like savings right now, if you were going to go and ask the typical American what savings is like for the average American, they would say it's worse than it's ever been. Average American actually has more savings right now than they did back in 2019 before the pandemic. You look at delinquency rates. Delinquency rates for bankruptcies, foreclosures, a lot lower than they were back before the pandemic. You look at credit card debt. Credit card debt's a little bit higher than 2019, but not that much higher. You look at revolving debt, you look at auto loans, you look at all of these things, and we're basically back at 2019 numbers. Now, I'm not saying 2019 was the pinnacle of...
Right, everyone was calling for a recession back in 2019, too.
They were calling for a recession, but at the same time, I mean, I think a lot of people look back before the pandemic and say, hey, the economy was pretty good. Might not have been perfect, but I don't.
It's always pretty good until it isn't. That's the problem.
But it was. That's the point. It was, and then the pandemic happened, and things got a lot crazy to say, but things got a lot better. Everybody got free money, so savings went up. Everybody got a lot of credit, so they felt like they had a ton of money. Everybody's houses went up in value. Everybody was getting loans at 0%. Everybody was feeling really good. And now we've kind of slid back down the slope to 2019 levels. And the fact that we've gone from so good to back where we are, people don't feel like we're in 2019 time, even though the data looks like 2019 time. They feel like we are in the depths of hell, because it's so much worse than it was a couple years ago.
Yeah, but remember, I don't. Let's just bring it back to, I think, the core of everything, right? Which is this whole inflation thing, right? And so if you're someone who spends 95% of their income on food and shelter, right? It's a lot of the sort of the lower middle class. When prices go up, that affects you way different than somebody who spends, 20% of their income on housing and things. Like if the price, if Kyle's prices of eggs go up double.
I knew you were going to do this. I knew it. The moment you started talking, I knew you were going to bring up eggs. You brought it up in the group chat. I knew you couldn't help yourself.
I don't even know what the price of eggs are, but if you're literally 90% of your thing, so inflation at the margins is a huge deal. And I think you can't say, oh, things are back to 2019, because if you look at absolute prices, we've had inflation, we've had increasing prices every single year from 2019 to today. Even if we went back to zero, we're still 20, 25, no, I don't know the exact numbers, but we're significantly higher. Maybe it's 20% higher. Eggs for sure are 20% higher than they were back in 2019. And that hurts. And if your income hasn't gone up, or you've been laid off, or your income has gone up a little bit, but these prices have, rent, look at rents. Like, I know rents have kind of, look at the price of housing. I mean, we're going to talk about housing a little bit in the next segment, but prices are down, but compared to 2000 before COVID, I mean, they went up for like 25%. Now they might be down 8%, but they're still significantly higher than they were in 2019. So, and that's what people are feeling. It's the inflation that at the end of the day, I think all comes back to that.
I hate to say it too, though, but I kind of like with AJ's whole thing about people having it too good. I also think that people like, yes, when things get a little bit more expensive, people don't want to give anything up. That's why credit cards are all-time highs. That's why like people don't want to like they feel the pinch and they just want to complain about it but not do anything about it. They don't want to say, okay, my apartment's up for lease, I'm going to downsize and you know, instead of getting a 1,300 square foot apartment, I'm going to get 1,000 square foot apartment next time. They don't want to do any of that. They just want to keep going and complaining, saying, oh, it's inflation. It's inflation's fault. When typically, like, as we've talked about many times, recessions just happen. People just adjust and the world goes on. We've kind of just been like taught this thing that recessions can't happen anymore and everything has to be great.
Look at AJ. AJ adapted. AJ downsized to
yeah. I'm living in a Winnebago.
I mean, he took action. He downsized, and everybody else needs to do the same thing.
Well, I have a question for you guys. What jobs? So the jobs report's coming out Friday, right? What jobs number would be good news? Because to me, if the number's low, then that's bad news. We got problems in the economy. We might be seeing recession. But if it's high, oh, that's bad news too, because that means the Fed's going to be higher for longer, and that's bad news because we might have a recession. So how are we? If we are in a cycle right now where I don't see a path to there being good news and in a jobs report.
I think it's if it comes down.
Last month, it was 175,000 was the jobs report, which was lower than previous months. And so basically we're in this kind of like holding pattern. Like, okay, if it's 175 or less, we might have issues because that's a couple months in a row where it's been lower than trend that we might have issues. But if it comes up higher, then that means, oh, that's 175 was probably just a blip. Higher for longer is on the table. So which one's better?
In my opinion, I think it's if the data shows that it's coming down. Now, once again, we've had this conversation about part-time jobs versus full-time jobs versus careers, right? We've gone through this, but I think that based upon the current situation where we are in the United States, I think it's lower.
I was going to say, jobs is a lagging indicator. And there are other indicators that are already starting to show that things are slowing down. Just this morning, we saw the manufacturing index, which is a really good leading indication of recession. It basically measures how much output there is by manufacturing in the U.S. And it was at 48.7%, if my notes are correct. Anything under 50% basically means that manufacturing is contracting. And that means that they're getting less orders. That means that prices are going up for them. That just means that they're cutting back. That's going to lead to layoffs. That's going to lead to cut hours. That's going to lead to lower wages. And so it's the leading indicator. Jobs is the trailing indicator. You look at the trade balance came out today, negative $100 billion. So, I mean, we're basically negative $1 trillion to mostly to China over the course of a year, which means we're going to see a whole lot less output of the domestic economy over the next year. GDP, we got the first revision, the second number for GDP for Q1. We thought the number was 1.6%, which was a lot lower than anybody expected. Turns out the revision has us at 1.3%. So the output from the economy is a lot slower than we expected. We got consumer spending last week. Consumer spending was only up 0.2% last month, which is a really low number. It's good. It means people are spending more. But anything under about 0.3 or 0.4% shows us big slowdown in the economy, given what we've seen. So long story short, we're starting to see a slowdown. But here's the crazy thing. Again, I feel like I'm being too negative because, again, there's recency bias. So seeing manufacturing contract, that shouldn't be a negative sign because manufacturing's been on fire. Seeing GDP down to 1.3%, that's not so bad because it's been on fire. Seeing consumer spending down, it's been on fire. So if you look at all these things, it's a return to normal, if anything. But because, again, it's a negative trend, it feels a lot worse than it is. And I feel like I've been on this podcast for the last month and a half, and I'm falling into that same pattern as well. I'm talking about like this doom spiral, stagflation and recession and all of these bad things. And if I really look at the data, the reality is if I ignore where things were 6 months ago and 12 months ago and 24 months ago, we're really just returning to a normal economy.
But and one of the problems though is, like you said, they were on fire. They were on fire. That, like, yes, that's not normal or anything, but that's what was driving inflation. We are moving into a capital shift. We had expansion, we have contraction. If we have inflation because of the $4 trillion in the economy, that was driving everything. We do have these lagging indicators. We are trying to right now get rid of all that money. That's the whole point. That's what everything's trying to do. You cannot affect, and this goes back to this idea of this soft landing. What does that mean? What is that like? What are we trying to accomplish here? Because at the end of the day, in order to affect rising, and especially the rapid rising, but the price of goods and services, you don't get that without pulling things back. So that's why I said I think it's better. Jobs numbers come down, and it's this idea that is just on fire. Everything good? Is that a good thing that we have unemployment at numbers that we've never seen in the United States? Is that good? Why? Why is that good? Well, we want every single person to have a job. Once again, it's a challenging of what we are even considering good. So this pullback to a normal marketplace, because people move from job to job, right? Part-time jobs versus full-time jobs. So employment to getting back to more of a normal, to have markets that aren't on fire, assets aren't rapidly growing, rent prices aren't skyrocketing, right? We don't have the cost of goods and services out of that. Well, that obviously we need a return to a normal and a pullback. And I think that that's healthy. I think that it's fine. And I think that if we want to see the Fed change course,
I think there's a legitimate chance that we have the Fed's going to have to make a decision between inflation and jobs, right? Right now, they can kind of toe the line between the two of them. But, it's inflation, they keep saying it's not coming down as fast as they want. We're basically at 2.7. We were like 400ths off of hitting 2.7 the core PCE print. But it's not coming down as fast as everyone hopes. But those jobs numbers are ticking up. Like, we very well could have this next jobs report. We could have a 4 handle for the first time. And I think people are going to all of a sudden like sober up a little bit and be like, whoa, 4%. Like that's still not historically high, but that's a lot higher than we had, a couple months ago. So I think they're going to get put in this position where they're going to have to decide between the two. And I just hope they pick jobs, to be honest. Like, I hope that they revert back to, like, as much as people are they have these polls and people are saying, oh, inflation's worse than a recession. I don't think they really mean that.
So first of all, the Fed does do that. So the Fed actually said that. That was what that one reporter went off after Jerome's, where they were like, so you're saying you want people to lose their jobs. Remember that? And he was like, I'm not saying I want it. I'm saying, though, that is an outcome of what needs to happen. So he's saying, yes, we are trying to raise interest rates and we need to see people lose their jobs. We may not like the reality of that, but they don't even shy away from it. The Fed doesn't.
To what point, though? I don't think they ever want to see it hit 5% on unemployment. I think they're okay in the 4s, but I think like it would be absolute panic in the streets if we hit 5% at any time. And as Jay just pointed out before, it's a lagging indicator, so they want to get ahead of that a little bit. And so they're going to have to make a decision at some point here. Once we start getting 4 handles on this unemployment, like at what point are they saying, okay, inflation's not great, but it's also, we've come a long way. It's materially heading down. Like, it's good enough. Let's start, stemming the bleeding a little bit on these jobs.
Wait, is that the new standard? It's good enough?
Here's the long-term challenge that the Fed has. Right now, as Mauricio has pointed out very well over the last many months, things are way too expensive and they're not going to get cheaper. Hopefully they're not going to get cheaper, because I think deflation is a bad thing. We don't want things to get cheaper. We want people to make more money.
Other than eggs. Eggs need to be cheaper.
Eggs are actually going up. I was just as you guys were talking, Mauricio had me doing some searches, and it looks like eggs are getting more expensive between the bird flu and some fires at some eggplants.
I knew it. And by the way, that's going to be. By the way, that is definitely going to be a future episode. Is deflation a bad thing?
Yeah, I think we should talk about that. Yeah, I think it's a great topic. But I still think that right now the key isn't that prices come down. I think the key is, and for some industries, some products, obviously we want to see prices come down. That's not unreasonable. But across the board, we just want to see wage growth. We want to see people making more money so that they can afford these things that are a whole lot more expensive than they were a couple years ago. And so for that to happen, we really need two things to happen. We need, number one, we need wage growth. And number two, we need inflation to be low. Because the gap between those two numbers, the wage growth, how much more people are making every year, and how much things are going up in price every year, the gap between those numbers is what's called real wage growth. That's how much more money people have to spend. And we need that number to be at 1%, 2%, 3%. We need people to be getting 3% more spending power every year so that in a couple years, we've basically caught up to inflation and people are back, relatively speaking, to where we were pre-pandemic. Now, to get a 3% spread between in real wage growth, we basically need wage growth at 5% and we need inflation at 2%. That's really the only way the numbers work.
Or wage growth at 0 and prices down 3%.
Again, we can have that discussion, but I think that's a more nuanced discussion than what I'm ready to have right now.
That also means we need super low unemployment, right? Because we need a competitive environment so that people can demand higher wages.
And this is where I was going with that. If we're going to have 5% wage growth and 2% inflation, we need a competitive jobs environment. We're not going to get that because as soon as we start to see inflation drop towards 2%, Fed's going to cut rates. Fed's going to cut rates and all hell's going to break loose and we're going to see more inflation and we're not necessarily going to see more jobs. And so I think the challenge the Fed has is how do they encourage wage growth?
You think a 1/4 point reduction in rates is going to just create all hell breaking loose? A 1/4 point. So people going from I'm paying 5 1/4, now I'm paying 5. That's just going to open the floodgates and everything's going to go nuts.
What happened in November and December when the Fed didn't even drop rates, but just hinted at the fact that they're going to?
Well, people learned their lesson a little bit there. We got a little bit carried away. They had to pull.
No, they didn't.
People are idiots. None of us learned our lesson.
Yeah, not at all.
In this case, it's the rich idiots. The wealthy didn't learn their lesson. As soon as the wealthy see a 1/4 point drop, you're going to start seeing a whole lot of money flowing into hard assets. So I think that the Fed has a really tough line to walk here because there's no way we're going to see the real wage growth that we need for people's spending power to catch up with the higher prices. And so the only other alternative is a major recession that basically does what Mauricio was talking about, which is
I disagree. I just think they need a little bit of cover. It doesn't need to be a lot. They just need a little bit of cover. We need a small spike in unemployment that they could say, whoa, look, okay, like that's bad. Like that spike in unemployment, that's bad. So we're just going to ease off a little bit just to make sure things don't get worse. And I think as long as they toe that line a little bit, everything should be fine.
Okay. Friendly wager.
Well, it doesn't mean that they're going to do it, but like they're just waiting for the first sign, a little bit of cover, right? Like, as you said, like they're in a tough spot. They need cover to lower rates. They can't just say everything's great, we're going to lower rates. They need to say, okay, there's signs of distress here. If you notice, like Powell's speech, the last like 3 times, he threw in the word unexpected, like unexpected softening, unexpected. Like he kept saying that. And I think he's just kind of setting the tone for that all of a sudden when he could say, okay, we've had some unexpected this, unexpected that. That's a reason that, we have signs of things aren't as good as we think they are. We're going to just start to ease off on it.
But you have to remember, they're there to protect Main Street, right? That's been their whole focus. Inflation's affecting Main Street. Right now, the vast majority of the United States is saying, we're in a recession. This is horrible. I'm getting slammed. And so the Fed's looking at that. The Fed's saying, people are not happy. And people are feeling
55%. So 55% are saying that.
Well, 55% are saying we're in a recession. Not that it's not bad. They actually think that we're in a recession.
Well, but also 50% of America, if Biden's the president, they're going to say we're in a recession no matter what. So
I don't think that's true. That's never happened before. So why all of a sudden would that change?
Jay, pull up the graph. Pull up the graph, Jay. Jay.
I'll have to find the graph, but I think we showed it on a previous episode.
It always changes. Yeah, I've seen it. It always changes. But at this level, because even Democrats do.
Yeah, whenever Republicans in office, the Democrats think we're in a recession. Whenever Democrats in office, the Republicans thinks we're in a recession.
Absolutely, that always happens. But as of right now, even 50% of Democrats think we're in a recession.
All right, well let's battle this out again next week. We'll hit Jay's topic. He made a good enough presentation and push for it that we'll bring in all his stats and we'll compare them, and we'll have to have notes so that we can argue against them, and we'll make it a good topic because we got to move on and talk some actual real estate here. While Jay is still looking for that graph, you could throw it up while I'm doing the intro if you want, Jay.
I'm looking for it.
Let's talk about Bank of America, because it's been a little while since Mauricio's been able to shit on banks and say there's distress in banks and things are happening there. So let's talk about a Bank of America recently, a loan portfolio sale renewed people's concerns about the softness in the banking sector. Bank of America agreed to purchase approximately 2,000 multifamily loans from regional Washington Federal Bank for a total purchase of $2.9 billion. Now, the outstanding balances of those loans were $3.2 billion. So this also renewed concerns that previously the Federal Reserve categorized multifamily alongside office as far as concerning CRE markets to watch. So Mauricio, I want to know, how do you consider this whole transaction and what the ramifications that are coming from it?
Yeah, I don't know why you're thinking I'm going to shit on the banks. I mean, I'm just reporting the facts here. I'm not going to say anything.
Just because historically you've always shit on them. That's
you mentioned it. You actually hit one of my points where, it's no secret, obviously, multifamily, especially on the loan side, has had some issues. The Fed recently came out and said it's now putting multifamily in the same category as office as sort of the areas of most concern in the commercial real estate. Transaction volumes, as you guys know, is down significantly. And I can attest to this just from being in the thick of things on the syndication side. It matches what we're seeing in our business, which is since 2000 and since 2001, 2002 peaks, we're down 61% in transaction volume from real estate, right? Because of the increasing prices. And you got to remember, prices went up quite a bit during the pandemic. Prices have started to come down. But with the interest rates just skyrocketing through the roof, it's just really created a lot of stress on a lot of the banks. And so the Fed's actually stepping in and putting a lot of regulatory pressure in a lot of these banks. And that's one of the reasons Washington is actually selling this portfolio. Because you'd have to ask yourself, why are they selling? What's the incentive for them to sell? And the obvious reason for Washington, for the bank, Washington Federal Bank, is that they're trying to pare down their exposure to commercial real estate. They're almost forced to do so because the regulators have come in, specifically the Washington Federal Bank. They came in and basically they had crossed two thresholds, problematic thresholds on their balance sheet. And those were, number one, that they were part of these banks where portfolios of their CRE loans had more than tripled or was more than triple of their entire capital of the bank.
Right. So that was actually my question that I was going to ask you is, did the Fed step in and basically say, you have to do this?
I don't know if they specifically sped in, but these are certain metrics that they had crossed. And so that puts them into really, really tough regulatory positions. So that being one of them. And the other one is that their portfolio had grown over 50% in the last 3 years. So those two, and there's a bunch of other metrics that they use, but they're just under really heightened regulatory scrutiny from the regulators. And so it kind of makes sense for them to sort of pair them. I thought it was interesting that they sold the 2,000 loans to Bank of America. Although Bank of America looks like they're just kind of the middleman. They're going to turn around and flip them to a couple of funds. I forget the name of the Pacific Investment Markets is actually buying these. But they sold them at a discount, but not a crazy discount. I mean, it was about 9%, 9.1, 9.2%, because they were worth about $3.2 billion, and they sold them for $2.9 billion. So there's a little bit of a haircut. But obviously, there's a buyer involved, right? And again, it's not Bank of America. It's actually the Pacific Investment Group. They're obviously banking. They think, the way I read this is they're thinking it's not as bad as everybody else thinks, and they took this as an opportunity because they're buying this at a discount, $300 million discount, and there's somebody who's already willing to buy them. And so the only way I see this, and I'd be interested in your guys' view, but I'm seeing this as they're betting that the default rate, or maybe not the default rate, but the actual losses on this portfolio are going to be less than 9%. So otherwise, why would you buy these loans if you think that you're going to lose more than that? So they were buying them at 90 cents on the dollar. It's not like 80 cents or 70 cents, which is really significant losses. That they were. I still thought they had a pretty good appetite for the investors to purchase. So obviously Bank of America, I think Bank of America is just making a nice little quick buck here. They're buying it at $300 million discount. They're flipping it to a fund, and they're gonna keep the spread a little bit, a few $100 million or a couple $10 million in spread. But that's really the main reason that the bank is actually getting rid of it. It's just that it's gotten so much scrutiny on it that it had to get rid of them. I pulled up a couple quotes that I thought was interesting because one of the Federal Reserve governors, Lisa Cook, she came out and said, she still is viewing commercial real estate. The risk is currently a sizable but manageable is the language they're using. It's a sizable problem, but it's manageable, and she's going to be keeping a closer attention on the sector. Jamie Dimon is saying that, hey, because many property owners are already handling the current levels of stress and the challenges of lower valuations and higher interest rate, this is already known. And I think he's saying that as long as we don't go into a recession, we should be fine in terms of the bank. The only one that's really kind of, some of these folks are concerned. The Financial Times is actually concerned because they're looking at a $2 trillion wall of property debt that is kind of exposed. But most people, at least on the market, on the media, are saying it's an issue, but it's a manageable issue. And I know, Jay, you've been talking a lot that you don't think this is a major issue, that's a little bit overblown. Even if you look at if you look at the overall numbers and you make some really aggressive assumptions that this is not going to be an issue. I don't think this sale, I'll give you my two thoughts and then I'll turn it over to Jay. I don't think this sale is necessarily an indication of some major distress. I think it is purely regulatory pressure because they crossed a certain line. They had to get rid of them. They got rid of them at I think a pretty decent price. I know 300 million is a lot of money, but it's less than a 10% discount. So I almost feel like Bank of America and the fund that's picking these up are kind of, in their opinion, obviously picking it up at a bargain because they're expecting to make, nobody's buying these loans expecting to lose money, right? They're going to buy these loans because they think they're going to make money. So they're anticipating that it's not the default rate, but the loss of principal is going to be less than 9%. And so their math, and these guys are pretty smart, their engineers have figured out that the losses are going to be less than this. So in their mind, it's not a big deal. Fed is kind of watching it. Jamie Dimon thinks it's not a big deal unless we get into recession, though. That's a big if. But Jay, you talked about before that you weren't as concerned as many other people. Are you still holding that view?
Yeah, I mean, I've been wrong about a lot of things over the last few years, but this is one thing I've been consistent and confident on, and I've been saying it since before the Silicon Valley Bank failure last year, that I don't see much risk in the banking sector due to commercial real estate or due to inverted bond prices and all that. And I think so far, I mean, knock on wood, I don't want to sound too cocky about this and then have something happen, but so far, I think history has kind of been on my side. Now, let's start with this particular transaction. Yeah, $300 million is literally a rounding error when you look at some of the issues banks have faced over the last year. If you look at the Bank Term Funding Program, it lent out $160, $170 billion last year, and this is $300 million. So what's that, 1/500th of how much was lent out through the Bank Term Funding Program? So it really is, I mean, certainly it sounds like a big number, but the discount that the bank was taking, that BOA was giving just to give some liquidity was such a small amount. 300 million is just absolutely nothing. I mean, again, look at the,
and it makes it realized, right? Like everybody was all worried about, like, oh, these big CRE portfolios, people have these huge unrealized losses. Well, they just sold it and they realized it, and it wasn't that big a deal.
Exactly. Exactly. Here's the other thing. I mean, I know we're concerned about banks, and I've been hearing for a year now that there's all these banks on the brink of collapse. How many banks, if you guys had to guess, how many banks have failed since Silicon Valley Bank? So remember last year back in March, we had Silicon Valley Bank, Signature Bank, and First Republic Bank all within like a month and a half that went into receivership or failed. How many banks since last April do you guys think have failed?
That's an unfair question, but I'm sure it's close to zero. Or I saw one the other day.
You would think a couple, because a couple fail just normally.
I saw one. Yeah, I saw one last week or a couple weeks ago, but it's probably two.
Yeah, it's three. And yeah, there was one about back in April, so about a month ago. There was one last November, and there was one in July.
But how can you fail, Jay? How can you fail if you have an unlimited American Express card that somebody's given you? Like you just can't fail. You've got a bank facility that just expired in March, so obviously now potentially it's an issue. But over the last year, if you had any issues, you just go to the Fed and you get a loan.
But we've talked about this. If you look at the bank term funding data, what you see is that from last July through December, nobody took out any loans. Banks didn't need the loans. They took them out between March and July because they saw an opportunity. Between July and December, nobody took anything out. And then in December, as soon as they announced that these loans were going away, everybody said, oh, I need a loan, because they didn't want to miss the opportunity for free money.
Which, by the way, if you look at the data, a bunch of banks did that, right at the end, right when they said, like, oh, this is the cutoff, a bunch of banks just flooded in right there and just bought it, took a bunch just in case.
Yeah. And so if this was really an issue, you should have expected to see a very consistent flow of money from the Fed to these banks between March and March. And we didn't. We saw a bunch at the beginning. We saw a bunch at the end when banks were taking advantage of the arbitrage. But in the middle, nobody was borrowing this money. So I would argue that this hasn't been a problem. Bank term funding didn't solve a problem. It created a problem that it intended to solve. And again, I don't see a lot of risk. Now, there was an article that came out. I think I sent it to you guys just before this show.
Like a crypto publication, though, right?
It was a crypto publication, but I'm going to assume it supposedly quotes the FDIC, but it says there's $517 billion in unrealized losses due to inversion of bond prices, and the FDIC says that 63 lenders are on the brink of insolvency. 63 lenders, $517 billion. Again, I'm not saying that's a small amount of money, but AJ, do the math. I mean, how many days does it take for us to print $500 billion?
A $500 billion? Not very many.
Yeah, we're printing $1 trillion. What was it? Every 100 days? 100
days is $1 trillion, so that's 50 days.
Right. So in this is how much the U.S. spends in 2 months.
It's like our 50th episode. Look at that. That's got to be some important thing.
So I mean, the reality is, I'm not saying it's not a lot of money, but Silicon Valley Bank was worth $200 billion. So if every single one of these bonds had to be cashed in because these banks needed liquidity, we're talking about the equivalent of 2.5 Silicon Valley Bank failures.
Yeah, but I think everyone's kind of moved past the whole like, oh, we're having issues because of these bond prices, the whole Silicon Signature Bank, like all the bond issues. Like I think we've kind of moved past that, and everyone just is like, oh, the Fed took care of it. They had that term funding, they got rid of it, no issues. I think we're past that now. So everyone has to move on and say, okay, well, what is going to be the issue? And now they're pointing at real estate, right? They're saying real estate's going to be the downfall of these banks. The bank, they're
and 6 months from now, or 2 years from now, we'll be past that as well.
Right. So, I mean, I guess I have to push back. First of all, I feel like I thought Mauricio was going to not be on our side as much as he was. So I appreciate him like kind of backing us up as commercial real estate investors there with his intro, because I thought I was going to have to defend us a little bit more. But when the article first came out about them classifying multifamily the same as office, we talked about discussing it and we decided against it because we didn't think there was a lot there. But I feel like I have to step in and defend it, and just to make the comment that like what a joke that is, right? Like to say that all of a sudden we're classifying office and multifamily in together, because they're completely different issues. They're completely different. Like the whole reason that we're seeing office delinquencies is not the same as multifamily. If you want to look at delinquency rates, like the overall delinquency rate in commercial real estate across the board is just under 5%, right? The delinquency rate for office right now is 6.58%. You know what the delinquency rate is in multifamily for loans? Less than 2%. So to try and say like, oh, these are the same thing, and people just like taking headlines and saying, oh, multifamily is in much trouble as office, is like just reckless, in my opinion. They're completely not the same. So and there's a lot more facilities for like help in multifamily as well, because people don't want apartments to go vacant, apartments to lose loans, apartments like they need places to live, and we have Fannie and Freddie backing, and there's a lot more things to help out that industry. So I just wanted to point out, like, it's like this isn't a multifamily issue. And I think, to Mauricio's point, the fact that it was only like a 9% discount, like we know the delinquency rate's about 2%. Like they're just making a spread on that. Like they're actually looking at this, and I look at it as a good thing that they're realizing these losses like on their books. Everyone's just speculating, oh, there's these huge losses on all these books. The moment they realize that's where we're gonna have issues. This bank took the realized loss and everything was fine. So I don't see real estate being the issue in banks. So I think it's time for people to move on and find something new to.
And I have talked about this, and I do want to be clear, because I've talked about it a lot of the last couple of years, actually, that you're right. With office, you have a problem with the asset. Like obviously the occupancy of office has gone down. People aren't using office as much. And so once these office lease renewals need to come in, that's a major problem. But with multifamily, specifically apartments, and it might be, I don't know if it's true in the other commercial real estate, but especially in apartments, the asset itself is holding up extremely well. Like rents, yes, rents have softened up a little bit, but when you look at rents and you look at occupancy in the multifamily space, it shouldn't be an issue. The problem is the debt. The problem is the loan. The problem is that the interest rate. The problem is the bridge debt. People having to refinance, and we got a problem. But if you took that out of the equation, I'm not saying that's not an insignificant thing. The asset class itself, I think, is until now has been holding up pretty well. And it's to your point, office is not holding up well as an asset itself. It's got major problems with occupancy and renewals that are coming up.
Also, let's keep in mind, I mean, and I was having this discussion with my kids a day or two ago. We were just talking about business stuff, and I'm always just trying to throw out little tidbits to educate them and help them figure out how the world works. And one of my kids—
Must be nice. I discussed the new Moana trailer with my kids, and you could discuss business.
give it a couple of years. My kids are now teenagers, so it's fun conversations.
Actually, Jay, before you go into your kids, I don't know if everybody knows, but your kids, I don't know if, are we paying them? Do they get royalties? Because they are part of the intro of Drunk Real Estate. That intro that we have is your kids.
That's Kyle's kids.
That's my kids. No, I pay them.
Oh, it's your kids. I thought it was Jay's kids.
Yeah, no, we need to do little things like that. We'll do a tax episode talking about some ways that you can little tax things, and I pay my kids. They're on salary, so I gotta put them to work.
Why did I think it was Jay's kids? I thought it was Jay's kids. That's awesome. Yeah. So anyway, sorry.
No, my kids have deeper voices than me right now. So one of my kids was asking about banks and how banks work, because somehow we got on the topic of banks. And he was as surprised as most people are. I mean, I know you guys probably won't be surprised, but most people are surprised when they find out that banks are really just businesses, regular businesses. They're not things that the government starts and the government says, okay, I'm going to set up a bank here, I'm going to set up a bank here and there. Banks are something that the four of us, if we wanted to go out and start a bank, we could. Obviously, there's a lot of regulation around it. We need to get funding for it. I'm not saying it's—
I was going to say, we looked into it, Jay. It's not that easy.
It's not easy. But the reality is banks are started by business people, regular business people. They're private entities that just happen to have, in some cases, a very good relationship with certain governmental entities to keep them solvent because people rely on them. But they're private entities. And it's really no different than any other business in the sense that some of them aren't going to be well run. Some of them are going to make bad decisions. Some of them are going to get unlucky. And some of them are honestly just going to fail. they're just not gonna they're not gonna be able to run their business successfully so that they make a profit for their shareholders, and they're either going to go out of business, or they're going to get consolidated, or they're going to get bought, or something like that. And that's not necessarily a bad thing. And so we need to stop kind of thinking about banks as these kind of governmental entities that can't fail because that would destroy the world, when in reality they're just businesses. And yes, if too many of them fail, and if there's too many issues that put people's deposits at risk, then that's bad. But having a few banks fail here and there, having consolidation in the industry, it's not necessarily bad. And here's the thing: what we'll see is, just like after 2008, 9, 10, 11, 12, once everything recovers, we're going to have a whole lot more people like us going out and starting businesses, and creating a whole lot more competition again.
Well, it's not that bad, other than the fact we're going to end up with 5 banks total, but that's another
I
discussion.
think that's unlikely.
All right. Final thoughts, Mauricio, on your topic?
No, I think this is. I actually do think that this new, on the face of it, it may look like, oh my goodness, banks are in trouble. But when you dig deeper, I think the sale price tells me a lot. Because if they had sold it for like 70 cents on the dollar, okay, it's not worth that much. But the fact that it got picked up by a middle person who's going to make some money in the transaction. So the ultimate buyer is probably buying this on 96 cents on the dollar. I think that's a vote of confidence in my book.
I feel like Mauricio watched that YouTube clip where it just shows how often Brad Pitt eats food in the scenes of his movies and how it's like a thing that makes him look sexy. And so Mauricio purposely just eats food every episode, regardless of the fact that we can literally hear him chewing while he's responding. And like that's the only explanation I could come up with, that like it's an hour and a half. Just don't.
If you can see my hair, you know I'm a more of a George Clooney type, not a Brad Pitt guy.
All right, let's wrap this up. Episode 50.
Before we do that, I actually did find that graph if anybody wants to see it.
Throw it up there. Let's look at it.
Throw it up.
Hold on, let me get the popcorn.
So going back to the discussion about partisanship in people's beliefs, here's a graph that basically indicates that depending on who's president, it really does impact people's belief, or at least their stated belief, in how the economy is doing. And what you'll see, if you're not watching this, if you're listening, what you'll see is that, like, going back to 2017 or late 2016, just before that election, about 70% of Republicans thought the economy was getting worse. And we were at about 10% for the Democrats. And then within a month of the election, it flip-flopped. And so it was the Democrats who thought that the economy was getting worse. Republicans thought it was getting better. Same thing happened in 2020, flip-flop again. Flip-flop again after the 2020 election, basically back to pre-2017 numbers. So it's very clear, if you're looking at this chart, that a lot of people, when they're asked the question, is the economy getting worse, they're not answering realistically, because things just don't change this quickly. It's literally, I'm not happy with whatever's going on in politics, and my answer to this question is going to reflect it.
You know what's amazing about this is to look at the numbers today to see how close Democrats and Republicans are in the fact that they think the economy is doing bad. That's amazing. Because as of right now, they're like 10%. That's it. So you have 50% of Democrats think that we're in a recession, where you have almost 60% of Republicans that think that. And that is really close. So you're talking about, even both parties agree right now, we are, and dude, this isn't getting worse. Like this show's getting worse or getting better. They actually think we're in a recession. So regardless of party line today, Americans believe we're in a recession, which is wild.
Yep. Okay. Let you move on.
All right, let's wrap this up. Top 10. Since we got episode 50, I asked Jay if he would look up our most popular episodes over the last 50 episodes. And actually, since Jay, you did the intro, why don't you walk through the top? Let's do top 5 because it could take a little bit of time to do top 10. Let's go through the top 5 episodes. So people, if they want to go back and check out our best episodes, it's very easy for them to do so.
Yeah, so I went through the data, and when I read the episode, I'm not going to read each of the topics in the episode, but for each of these episodes, it felt like there was one topic that kind of stood out above all the other topics in the episode, really resonated with people. So number 5 was episode number 10, where AJ did an amazing job talking about the self-storage meltdown, and not just like the meltdown, but just how the self-storage industry works, what it's predicated on, how it's impacted by the economy. So if anybody out there is listening is interested in self-storage and why it moves the way it does with the economy, check out episode 10 and AJ self-storage meltdown. Number 4 on the list was our very first episode, the inaugural episode. We talked about just basic economic stuff. We talked about inflation. We talked about commercial real estate. And not surprising, that's in the top 5 because we had a lot of press that first week. Number 3 on the list was episode 29, which was our 2024 predictions episode. So that was the beginning of the year. We made predictions for where we expected things to go.
Should we really be sending people back there? I know a couple of my predictions have already not come true. So let's maybe just skip over that.
Well, I'm going to foreshadow here. We are going to do a mid-year predictions episode where we're going to recap where things stand from our beginning of the year predictions episode, and then talk about where we think things are headed. So definitely check out episode 29 so you won't be surprised when we jump into our mid-year predictions episode. Number 2 on the list was episode 48, where we talked about an economic slowdown. Don't know if there's anything specific that stood out there.
We're just getting better, Jay. We're just getting more popular.
We are. That was 2 episodes ago. I think we're just getting more popular in general. And then the number 1 episode, I got a lot of good feedback on this. We got a lot of downloads, a lot of views, was episode 44, where we talked about, specifically Mauricio talked about the dollar milkshake theory. And it's surprising the number of people that come up to me and we talk about the show, and I ask them, what resonated with you? And so many people really loved that episode on the dollar milkshake theory, and basically the predictions about what's going to happen with the U.S. dollar and global currencies and liquidity and all that stuff. And it was a complicated topic, but I think Mauricio did an amazing job of really boiling it down in a way that everybody could understand. So number 1, check out episode 44, which was the dollar milkshake theory.
I think you should have cross-referenced what the top 10s were in those episodes, because it's probably the top 10s, how good they were, that put us up over the edge. And so there's some of these top 10s, they're very well thought out and very well polished and have great response.
That's the only reason Mauricio's did good. Honestly, the only reason Mauricio's episode did good was because of the top 10.
I hear most people just jump right to the top 10 when they tune in.
Yeah, if they can't listen to the whole episode, if they're a little tight on time, they just skip right to the top 10. And
that's all Mauricio does. He just zones out till the top 10.
I just pulled up on ChatGPT that only, according to ChatGPT, whatever the source was, 17% of podcasts make it to 50.
Nice.
Ooh, there we go. And I'm sure it gets lower and lower. That's we've been a year, right?
Well, it can't get higher.
Oh well, it's been over a year, so that's a pretty good. We got to start talking about marriage at our age. Jeez, over a year together. That's it's getting serious.
Oh yeah, guys, this is serious.
Speaking of marriage, I went to the first wedding I've been to in years last Friday.
I saw the picture and I saw you without a hat. I didn't recognize you.
Yeah, you want me to take it off? I got a haircut and everything for that wedding. It was I got nice and tight here, boys. And boy, I could drink as well as I did before, but I pay for it a lot longer. I'm still that was a weekend wedding. I'm still not feeling right now. But anyway, it got me to thinking. It was a traditional wedding, a lot of people there, and how much money is spent on these weddings. And I assume you guys all had traditional weddings, but now a lot more people are doing this elope thing, destination weddings. So if you could do it again, Jay's shaking his head. If you could do it again right now and you were getting married, would you have a traditional wedding? Would you go and elope? or would you do one of these destination weddings at a like
I did all three.
Cabo or something?
I'm going to take this as a win because one of the few things I've done right in my marriage. But I suggested when Carol and I got engaged that instead of doing a big wedding, a traditional wedding, we basically had pockets of friends all around the country: California, Utah, Georgia, New York, Maryland. And so I said, let's do 5 big parties, one in each of those spots. We'll invite all the people we know in that spot. We'll do a huge party. We'll get it catered or go to a dinner. And so we basically had 5 small weddings that were informal, just with like our best friends in those areas. They all knew each other. And it was great. We got the benefit of having basically 5 weddings for the price of less than one, and still best decision we could have made.
So you would do that again?
100%. I think Carol would too.
Mauricio, what about you?
Well, we did 2 out of the 3, whatever the third one. So I wouldn't call it an elope. I think elope means you don't tell anybody and you leave. I don't know if that's really the definition of elope, but Heidi and I got married with nobody around. It was just me and Heidi on a beach in Belize. So we did the destination wedding with nobody around. And it was awesome.
I remember you invited all of us, but none of us wanted to come.
Right. That's really what happens. We invited 100 people and everybody's like, can't make it. So we ended up just being us. But it was awesome because you know what? The wedding day was like, we just chilled at the pool. We had lunch. We had manicures and pedicures. We did a walk along the beach and with zero stress. And then we had the wedding and just did some amazing photos. And it was awesome. I would definitely do that again. It was zero stress.
AJ, I know those Mormons, they like to sneak off and elope when they're 16, right? Isn't that the norm?
That's getting pretty old. We usually tend to like to keep it around 14. We keep things fairly low key. Most of the time, Mormons are pretty cheap, so they usually like use the local church, and then they have like family, friends, everything else go. It's kind of, we did it. We had like our we were married in a temple, which is great because everything's done, set up, right? Everything's great. So it's free and we don't have to do anything. So if I had to do it again, which I wouldn't, obviously, but I actually like Mauricio's idea. I don't want, we did like, we had a big thing in Kansas and one in Boise for her family and my family, which was great because like, it was really about the parents, right? Because we're in our 20s. And so that's really what the receptions were for. It was for the parents. It wasn't really for us, right? And so we did it for them. But so if I ever had to do it again or whatnot, I'm Mauricio's way all the way. I'll go to some destination, just us, and do it for us. I love that.
Well, destination weddings are just so easy, right? Like,
would you get married on your private jet, or would you do it actually in a place?
Mauricio just will not drop this private jet thing.
If you haven't noticed, I am jealous.
Episode 500, AJ is going to be upgrading, getting a new jet, and he's just going to gift you one of his jets, and it's going to be the best episode ever.
I actually think I suggested that we do episode 50 on your jet on our way to Coeur d'Alene. I think that was part of one of my master plans, and we talked about it. I thought maybe it was going to happen.
You know, we could do like get Starlink. If we needed to, well, I guess if we were all together, we wouldn't need.
We'll just record it locally. We don't need to be streaming. If we're all together, you just record it locally.
Okay, I'll get that set up and we'll fly.
Well, so yeah, because when Jay and I did a podcast together before, where we went and did it on Steve Lloyd's yacht. So we went out on his boat and we had 4 of us out there. We just recorded it locally, and it was like out in the marina in Florida. Where was it? CSP.
I'm in a van. Why don't you want to do that, Mauricio? You could come hang out in Ryan Murdoch's van with me.
Yeah, park it down by the river.
Dude, I tried, and I got shut down because Kyle didn't want his feelings hurt.
Half stories. All right, are we doing plugs? Jay, you got something for us?
I'm gonna plug your wife again. So next Wednesday, she is doing a webinar on 5 ways to find multifamily deals. If you're a multifamily investor or want to be a multifamily investor and you're looking for deals, check out the show notes. I forgot to put them in the show notes last week until a couple days later, but I will promise to put them in there this week at the very beginning. So check out the show notes for the registration link.
Mauricio.
I'm going to plug. I was on fire today on Instagram. I did 13 stories, just answering people's questions. I do Mondays with Mauricio. So on Mondays, I just do a little post. You guys ask questions, I answer them. So at Mauricio Raul on Instagram. I need to get to 10 followers. So please, please, please follow me on Instagram so I can cross 10 and start my way up to 50.
Well, 10,000's the like a big deal on Instagram, right? Like that's you get like access to like the real Instagram.
Dude, I have a better shot of getting on a private jet than getting freaking 10,000 followers.
Well, just get AJ. Isn't AJ doing his bikini photos right now? Just get him to send you one, and you could exclusively post it on your Instagram. There you go. Instant 10,000.
Instant 10,000.
Had I been able to be there, Kyle, in person, reporting on my Instagram, it would have been money. But no, you shot that down and said, nope, we're not going to Coeur d'Alene.
Once again, that's not what happened. But AJ, what do you got to plug?
All right, since there's probably only like 5 people listening still at this point, I am going to plug something that I'm not even supposed to because my marketing team told me not to, but I'm going to. My new book is out actually on Amazon. It's 450 pages. It is huge. It's ridiculous. But the first book was, I think, under 150. This is all new information. And for anybody that goes, leaves a review. And so anybody that goes, leaves a review, and they take a picture of the review, send it to us. We are sending them a whole bunch cool stuff. So we're shooting them over. So it's nobody even like we haven't done a launch, nothing. So this is the first time I've talked about it on a podcast, anything else. So you can go jump on there and pick it up today.
How many pages?
450.
It's 2.8 cents a page.
I kind of regret that I already bought it. Just like 400, that's way too long for me. Out of my attention span. I'll get back to your review of that book is coming in a couple months for me now, buddy.
Kyle, get the ebook, feed it into ChatGPT, and just have them, do a 200-word summary of the book.
That's perfect. Or even better, audiobooks. Audiobooks at 1.5 speed. I crush those all day at the gym. And
I got in a lot of trouble because the first book, I did not do it. It wasn't my voice. So all my podcast listeners got the book, got the audio version. They were expecting me, and I got in a lot of trouble. So then I promised everybody, oh yeah, my next one, because it was supposed to be 150 pages, I would do it. Now it's 450 pages. Do you know how long it's going to take me to record an audiobook? I'm like, oh.
I think the 4 of us should do it.
We'll each do a little section.
Dude, I'm absolutely down with that.
All right. Well, my wife already got plugged once today, so I think that's enough for her. So I'm going to plug Conference Connect again. Go check out Conference Connect if you're into conferences, looking for reviews at conferences. If you're a speaker, looking for a place you want to speak, go and leave some reviews. We're looking to get people to review conferences. Go check out. I think Limitless is coming up. Joe Fairless just had his. Go leave some reviews.
When is the drunk real estate conferences? Is that cruise? September, October? Oh, it's a cruise. The drunk real estate cruise? Is that?
We haven't announced it yet, but if you're interested in the drunk real estate cruise, leave us a comment below.
Yeah, booze cruise. Just a lot of karaoke and talking real estate.
But all you non-drinkers, you can come too. Hang out with me.
Absolutely.
All right. Hey, we made it, boys. We made it through episode 50. We all back again next week? Or are we losing somebody?
Yeah.
Here next week.
Here next week.
Jeez. Boys, this I'm starting to think you're actually having fun with this. You want to be here, and that's great. I love that. All right. Well, it's been a pleasure, gentlemen. I think we're back on a normal time next Tuesday. Instead of this week, we're Monday. So my drink is gone. I'm gonna go hit the head. So I will see you next Tuesday.
See you guys.